Are you seeing any distressed assets come to
Yes,
the market? What are
100%.
you seeing? What are
We've
kind of
we've
things you're seeing?
completed over 455 BOVs for lenders just here in the Chicago market, in the Midwest
Right.
market.
Broker's
Uh,
opinion value. Yeah.
yeah, yes, yeah, opinions of value because a lot of times lenders or banks want to reach out to brokers to get that. They don't want to necessarily pay for appraisals on these, especially when you're talking about hundreds and hundreds of units and buildings. So that, the 455 broker opinions of value that we've done in the last 18 months is 450 more than I've done in the previous 5 years, right? So that could
Exactly.
kind of tell you what's going
Right.
on with the marketplace. It's interesting because I know you've been through a few cycles. I've been through a couple. The last cycle that had significant distress was the GFC, right? Starting in 2009 through about 2011, depending on where you were. We haven't seen anything like what we went through in that period up till now, but it's still trickling in, right? And especially in the multifamily space.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this YouTube podcast series, Real Estate Market Watch, mark current events through a real estate lens. My guest today is Reid Bennett, who is he's the National Council Chair of Multifamily Properties, and he is a multifamily expert, obviously, with SVN based in Chicago. So he does some training of brokers across the country. So he has very deep insight into exactly what is going on in the multifamily world. And you're going to be hearing some of those insights there. Actually, we have a very interesting conversation. I didn't actually realize that Reid's primary focus was affordable housing. In fact, he and I have spoken on the podcast before. So you're going to learn a lot about affordable housing, what's going on in that market, as well as some broader trends and uh, impacts on the multifamily market overall. Yeah, very interesting conversation. If you have not yet done so, please subscribe to my newsletter at gowercrowd.com. I summarize these podcasts, sometimes send out some AI tips that we're doing with our clients, as well as some tips and hacks on how to be raising capital in this extremely uncertain and difficult market. All there at gowercrowd.com. All right, let's get on with it. Reid Bennett, National Council Chair, Multifamily Properties, coming right up. Reid, how good to see you again. Thanks so much for joining me on the podcast. All right, so the big question, of course, is what actually is going on in the market? What are you seeing these days? First of all, what's your specialty? I know there's one person out there that doesn't know, but for him, let us know. What's your specialty? Where are you? And
Sure,
what do you
no
see?
problem. No problem. I appreciate you having me on again. I love chatting with you. I love chatting with you on LinkedIn as well. So my specialty, so I have been brokering market rate and market rate and affordable housing assets across the country for 24 years. Um, I'm the National Council Chair of Multifamily for a company called SVN International. We have about like a little over 220 offices around the country. So I'm working in different markets around the country with a number of my clients, but I'm based here in Chicago, Illinois. Majority of my team's activity is in the Midwest, Illinois, Indiana, Wisconsin, Iowa, various other parts in the Midwest. And we focus again on affordable housing, both low-income housing tax credit deals, light tech deals,
Hmm.
HAP contracted properties, which is project-based Section 8, and workforce housing market rate. So hopefully that gives you a quick synopsis of what
That's a
I
good
what I do.
synopsis,
All right.
actually. Actually, it's good because it gave me a few more questions. I was
Okay.
sitting here otherwise wondering what to say. Uh,
Right. So I mean, so your question is, how's the
yeah.
market? I guess it
What's going
depends.
on
It
exactly?
depends. It depends on where you are. It depends on what asset class you're in.
Hmm.
And then within that asset class, what specialty niche in that asset class are you focused on? So it's very difficult to answer that question unless you're coming from a specific niche as to how the market is, right?
Okay, so I have a high level question. Actually, what the real question I was asking was, are you seeing any distressed assets come to
Yes,
the market? What are
100%.
you seeing? What are kind of
We've
things you're seeing?
completed over 455 BOVs for lenders just here in the Chicago market, in the Midwest
Right.
market.
Broker's opinion
Um,
value. Yeah.
yeah, yes, yeah, opinions of value, because a lot of times lenders or banks want to reach out to brokers to get that. They don't want to necessarily pay for appraisals on these, especially when you're talking about hundreds and hundreds of units and buildings. So that, the 455 broker opinions of value that we've done in the last 18 months is 450 more than I've done in the previous 5 years, right? So that could
Exactly.
kind of tell you what's going
Right.
on with the marketplace.
Mm,
Um, it's interesting because, I know you've been through a few cycles. I've been through a couple.
mm,
The last cycle that had significant distress was the GFC, right? Starting in 2009 through about 2011, depending on where you were.
mhm.
Um, and we haven't seen anything like what we went through in that period up till now. It's like, but it's still trickling in, right? And especially in the multifamily space, because the metrics are still so robust. The big difference, and I think we talked about this a while back, but the big difference between the downturn of the great financial crisis and what we experienced anytime between COVID and even, the whatever it was, the 550 basis point hike in the rates, which kind of paused the market in 2023 and 2024. The big difference that we're seeing is the the jobs reports have been relatively robust. I mean, obviously they keep fighting about, going back and renewing the
Adjusting.
reports.
Right.
But what I hear from a lot of the multifamily owners and workforce housing side, and even in the higher class A, class B, is there are a few things that are happening that didn't happen in 2008, 2009. 2008, 2009, anybody that couldn't afford a loan was able to get one, right?
Mhm.
So there was a mass exodus out of apartments into homes that they couldn't afford.
Mm,
So, occupancy levels in multifamily were, dipping down into the 80s just because people were leaving or losing their jobs. There were two things that were going on at the same time. We have
mm,
not seen any of that the last 5 years, right? So occupancies have been, depending on where you are, somewhere between 93 and 97% occupancy on a lot of these multifamily assets. And I attribute a lot of that to the fact that the would-be home buyers that are sitting in apartment buildings, even if they want to leave and they have the financial capability to get a loan, a 7% 30-year fixed loan or a 6.5%, it's dipped down a little
mhm,
bit lately. Even if they can afford that, the people that have a 2.75% 30-year fix that they got in 2020 or 2021 or 2022 it's basically like rent control. They're not leaving. They're not putting their house on
mhm,
the market, so there's zero inventory. So when the inventory comes on, it's ridiculously, um, the asking prices. I mean, even here in Chicago, the asking prices on homes are, 30% higher than they were 3 years ago. And
mhm,
so now you have triple the cost to get a mortgage, and the properties are higher than what they were when the pricing was or when the mortgages were lower. So it's keeping people in. I'm talking to owners that are saying, here's what buyers are willing to pay for your property based on their debt restrictions, right? And the capital restrictions that are going on
mhm,
right now. And the sellers are saying, I don't care what their capital restrictions are. Why would I sell my deal when I'm raising rents $100 on my renewals? So it doesn't make much sense.
mhm.
On the flip side, owners, and this is a long-winded answer, by the way, to your question.
It's fine. It's all good. It's
Yeah, but on the
fascinating,
flip
actually.
side,
Yeah.
as you know, the expenses are crushing a lot of the gains, right? That, a lot of the double-digit percent increases that we've seen over the last 3 or 4 years
Mm.
are getting, chewed and gnawed away at by, ridiculous insurance costs. A lot of the tax bills are always in arrears, right? So when the assessors in the various, geographic areas are catching up to the ridiculous prices of 21 and 22, they're finally, applying those to the new real estate tax rates. So just between taxes and insurance, and then, don't even get me started on all the complaints I'm hearing from owners and operators that they can't find good help, both from a maintenance staff to a management staff to a leasing staff. Um, it's just people are having a very difficult time finding good help out there. So those three areas are really pushing up the expenses on these assets.
Reid, what a fascinating response and very detailed. I really appreciate that. There's a lot embedded in that. Um, The home ownership thing is interesting in comparison to the global financial crisis. I mean, you and I both went through that. And
Yeah.
that is a fundamental, I mean, fundamentally different. In fact, the pendulum has swung entirely the other direction. It's impossible to buy. And so
Yes.
pressure on housing. Are there any, so your focus is also on affordable housing. And I
Yep.
assume that, well, based on what you've said, that includes what I think of as affordable with a capital A, meaning
Yes.
something is defined that way. And perhaps you can explain what that is briefly, but also you mentioned workforce housing.
Sure.
Have you seen any government initiatives, recent government initiatives? And we'll get to immigration in a minute because I'm interested to know what the impact is. And you talked about people getting help. But in terms of the tax bill or otherwise, that is either helping or hindering affordable housing or, uh, you know, either development of more or transactional volume or what do you
So are you
see?
are you talking about the recent bill that was just signed into
Yeah,
law?
taxes, tax bills, or
Yeah.
whatever. What factors are coming out of Washington that are helping or hindering this affordable, specifically affordable housing?
So with the affordable housing, they locked in the tax credits, right? They locked in the tax credits for the affordable developers, which is a key initiative of providing affordable housing for those that are, I'll just simplify it. Those that are 60% or below the area median income or the AMI, that's where the middle rung of affordable housing is. So you can talk about affordable housing from the standpoint of the workforce housing that's being built,
Mm.
and that has zero subsidies, zero income restrictions, but it's typically for the workforce that is not going, it's not going to be what they call it lifestyle apartments, right? Lifestyle would be the Class A, highly amenitized apartment buildings. The workforce housing might be a little bit further out in the secondary and tertiary markets, the garden style apartments, that are rented to, maybe factory workers or, the farming industry or, something along those lines would be workforce
Right, and
housing.
so it's all market rate.
Correct. That's all
Yeah.
market rate. And then I would say the next tier of affordable housing would be where you have the tax credits, low income housing tax credits or light tech.
Mhm.
And that is just uh, a system around the country that every state has a certain amount of funds per capita that a lot of the developers try to qualify in order to obtain the tax credits, which go into building affordable housing. It's typically a 30-year affordable housing uh, contract.
Restriction.
They're going to be a restriction that they're going to sign,
Right.
and it's typically for 60% or below the area median income. So think of it as, maybe a lot of the teachers, firefighters, maybe the
Mm.
staff at the restaurants in certain markets that might be priced out of those markets are set aside where you have to qualify. You cannot make more than 60%. And then some instances it tiers down to 50%, 30%, 20% of the area median income.
Mhm.
So then that, um, and which what we've also seen an interesting trend within that is, um, so there's a thing in that, and I don't want to get too granular, but there's an initial
Mm,
compliance period for 15 years where the operator that owns these or the developer has to maintain the affordability for the initial 15-year period, and then an extended use period of another 15 years. Well, there's ways that you can take those properties out of the program and bring them back to market rate. So there's a number of different execution strategies on the back end of those deals that can go either a new re-syndication and maintain the affordability. A lot of market rate buyers are trying to buy these deals because they can't make sense of all the market rate assets. So they're looking at these light tech deals after year 15, and then
mm.
they either maintain it and operate it as a multifamily asset, or they take it out of the program through a thing called a qualified contract. Again, getting too granular on the light tech. And then,
I do know that this stuff is incredibly complicated and very, very technical, very difficult to put together. My experience of light tech is that it's largely driven for those who develop by fees.
yes, it
Right.
is. But what I've noticed in the space is it's gotten so competitive
Hmm.
that a lot of the developers in their package, when they're submitting, they're deferring their fees. Not it's
Really?
not, it used to be like an upfront fee, or a developer would get a
Right.
750,000 or $1 million developer fee for doing this, because there has to be some incentive
Hmm.
for somebody to go through all of this and then also to maintain the
Mm.
affordability. It's a lot more costly to run an affordable housing deal than it is a market rate deal.
Hmm.
Um, so that's the situation there. And then the top tier. Did you have any questions about the light tech?
Well, only, yeah, it's kind of, yes. My question is, what do you do in that? So do you find land to help developers buy and develop, or that's not what you do, right?
I don't have enough intestinal fortitude to sell land. Um, so what
So,
we do
yeah.
is, yeah, I
Well,
mean,
how often do these things transact once a light tech develop? I thought they just held on to them and
it
yeah.
depends. It depends. So what we
Mm,
do on the from the brokerage side is there are two ways that we I guess there are three ways. One is, which is an interesting thing, which is an affordable housing developer can buy an existing apartment building that is
mhm,
market rate, that might size up well or score well. It could
mhm,
be it's sitting in, so every year the government HUD creates these, they're called qualified census tracts.
mhm,
And if your property is sitting in a qualified census tract, it just means that they're targeting them for affordable housing.
mm,
So we've sold market rate apartment complexes to affordable housing tax credit groups that buy an
mm.
existing market rate deal, and then they go through what's called an acquisition rehab utilizing tax credits.
Interesting.
And
And so
so,
that's based on turnover. You bring in low income tenants.
no, that's just based on usually there it's a property that has a lot of deferred maintenance, and either like a market rate buyer will come in and maybe do some light renovation, but if a affordable housing tax credit
Hmm.
developer comes in and buys um, a property that has a lot of deferred maintenance, they'll end up putting, and we're working on a deal right now where uh, they're looking to put $70,000 a unit in utilizing tax credits, where maybe a market rate buyer will come in and put 10.
Five.
Yeah, 5 to 10. Like
Exactly
10 would be
right.
at the top end, right?
Right, I see.
But I mean, we're
And that
talking
also
for
means, but they're turning over the entire. They have to remove all the tenants to put in low income
correct,
tenants.
or it'll be a number of buildings where they'll do a building at a time, and then
Sees. Okay,
maybe if the tenants qualify from an income standpoint, they can kind of start filling them back up with that.
I see.
Um, but so that's one way of doing it, where you're taking actually a market rate property and putting it into the program, but you're
Mm.
infusing a bunch of capital into it and bringing it up. A lot of times you'll never know the difference between a light tech deal and a market rate deal when you're driving up to it, right?
Hmm.
It'll have a it'll have a pool, it'll have a clubhouse, it might
Right.
have, just really nice amenities. but it's
Mm.
just set aside, um, for those that are in that, median income. So then the other thing is, so you can take a market rate deal and bring it into, utilize the tax credits there. The other one is you can take an existing tax credit deal after year 15 and re-syndicate it. Because a lot of times after 15 years, a lot of the fixtures are, the property's getting tired again. So you can
Hmm.
infuse it again with another tax credit strategy. So those are two different ways. And then so we sell either the market rate deal to an affordable developer or to a market rate buyer, or we'll sell a low income housing tax credit deal to a market rate buyer or to a group that's going to re-syndicate it. So there's just a number of different execution strategies with these
And are you seeing more or less activity currently? Like a general. Last time we spoke, you were very quiet,
yeah.
and frustratingly, it's like worse than you've ever seen before. So
Yeah.
how is the world treating you now? And I'm not sure how long ago. That wasn't that long ago either, Reid. Probably this time next year. I don't know. I could have a look, but it's
Yeah.
probably not that
Yeah.
long ago.
So
So
yeah,
like
so
dramatic changes since we last.
yes. So just from my team's personal perspective, and you know, I coach brokers through another platform around the country, and so I get to hear, and it's all multifamily that I focus on with that as well. So I get to hear from different areas of California to Washington, D.C. to New York to
Mm.
Texas, how
Mhm.
other multifamily brokers are faring during this time. And it was all very similar. 2023, 2024, with the interest rates, and everybody was kind of, what's going on? Just it was a pause.
Mm.
And we saw in certain markets, and we definitely felt it here, a drop in about, 73% of the activity. So
Mhm.
now you have all the brokers, including us, going after, about 20% of the activity, 20 some percent. And we're all trying to do the same thing. So we saw a drop in our volume this year. And we're talking right now, in September of 25, we could have either the second best or the best year ever that we've ever had.
Unreal.
So it's very strange. I mean, it's the strangest market we've ever seen, but
What's driving that, Reid? Seriously, I mean, all I hear about is uncertainty and everybody kind of holding fire.
there's major uncertainty, which real estate does not like, right? As you know. But you're talking about this bill, that's now a law
Hmm.
that, one of the things that it did was it locked in the 100% bonus depreciation, which we saw in 2019, 20, 21, and 22 when it was at 100% bonus depreciation.
Hmm.
We saw groups come in and stretch just to buy an asset that they could depreciate to
Depreciate.
wash some of their other gains and their other assets.
Mm.
So we're seeing a little bit, once that was locked in, we saw a little bit of an uptick of excitement because people could take advantage of that, which drives a little bit more activity. Um, and I think, on the other hand, even though rates haven't kind of leveled off exactly, everybody's anticipating a rate drop here, a rate drop there. I don't think it's going to be that significant. But people are finally just saying, okay, rates are what they are. Historically, they're ridiculously low. We got so spoiled with, 3% rates and sub three. We just sold a deal that had, an assumable HUD loan that was 2.37% fixed until 2055. So
Oh
we
my
got we
goodness.
got so spoiled with
Yeah.
those rates that everybody's complaining and belly aching about, 6% rates, which if you were talking to me in 2006 or seven, everybody'd be bragging about,
That they got a
a
six.
six and a
Yeah.
half percent rate. So, I think a lot of the current activity is at the point where, you know, people realize, all right, this isn't that bad. It's only bad for the people that have loans coming due that they have to, refinance, and they have a cash in refi of a loan that they
Right.
had. that they just thought
Mm.
rates were going to stay the same forever.
So do you think those people do you think that banks or lenders, or at least my sense is that lenders and borrowers who are coming up to maturities are pushing out those maturities in the hope that rates will come to the rescue. I mean, Powell is going to be
Yes.
timed out in May. There's a what people are pricing in 100% chance of at least 25% next Wednesday.
Yep.
Uh, POTUS is talking about 1%, and so there's a sense that interest rates are going to come down dramatically, at least short-term interest rates. Do you get any sense that people are hanging on to that, especially those that are facing maturities or otherwise struggling with interest rates?
Oh yes, yes. I mean, I've seen the whole. I mean,
Mm,
we saw it in the GFC where it was the whole extend and pretend, right?
right.
We're seeing that now as well.
Mm.
Um,
Well, the difference is here. The difference, in the GFC, there was extend and pretend, but there was no light at the end of the tunnel.
Correct.
It was a dark tunnel, right?
Correct.
We were looking at systemic failure.
Yeah.
This time, right, my point is that there is a reasonable chance that one way or another, interest rates will come down. To what extent, we don't
Yes.
know. So,
Yes.
okay, they are extending. Are they really pretending? I mean, is there much of that where people are just hanging on? And do you think that that will have a huge rush, create a huge rush of activity as all these moribund deals suddenly come back to solvency? If they do, assuming they do.
Well, it really depends again. You'd have to look from a situational depend. I have a number of these syndicators that I watched come into the market in 2018, 19, 20, 21, 22, and then
Hmm.
they really came on strong in 22, right? When they're catching the back end where they're seeing, you know, a lot of the syndicators got lucky that got in 19,
Hmm.
and then caught like a 4x multiplier, and then now they're pushing that out to all of their investors saying, here's what we did on this last one. Here's a new deal that we have. You
Is
know,
our track record.
here's our track record,
Future returns.
and I will never again. And I invested in groups that kind of were newer that were offering this, but I'll never invest in somebody that hasn't been through at least one downturn, right? Um, but so then they were just taking the proceeds, and everybody's like, let it ride on black again with you guys, in
That's right.
21 and 22, right?
Yeah.
And they're getting caught because
Mhm.
we always talk about 7 to 10 year amnesia in real estate. We all have it, right? Where we all forget like how painful it was 7 or 10 years ago.
It's funny that you say that. My sense of the way that the market works is more like people forget how painful it was 7 to 10 months ago.
Yeah, right.
Right. So, all right,
Right.
let's get back to it. Everything's great now,
Yeah.
and
Yeah.
forget the lessons. But so it's okay. So again, I'm interested in distress. I don't sound like a gloom and a doomer, but are you seeing any opportunistic deals coming to the market? What kind of characteristics? I mean, you've done 450 BOVs. Are the banks, are they, as soon as here's the thing, as soon as a bank gets a BOV, they have to write it to that level, right? I mean, they have to mark it to that level, I
Yeah.
think, right? So if it's below value, it's going to hurt their books. It's kind of, again, I'm not 100% technical, certain. I know if they get an appraisal, it has to be marked to that on their books. And if it looks bad, they've got to sell the note or they've got to divest in some way. Are you seeing any kind of activity from all these banks doing these
Well,
BOVs?
we're not seeing much yet from them. Not seeing much. And it's
Hmm.
interesting that you say that because we did have one lender that we were asked to do a BOV, but they did not want us to send it to them.
Yeah, just call us.
We
Yeah.
yeah, we had to go over it
Wow.
on Zoom, then it couldn't be recorded.
Yeah. That
So
that's why.
yeah, yeah, because they don't want to have that on the book, so they don't have to be
Right.
able to mark it or put it in the file. Before,
Hmm.
they wanted these BOVs so they could pad the file with it to kind of build up the, what they were going to charge them down to. So I,
Mhm.
I just don't see any of that
So what's
yet.
causing the active? Why are you getting all these BOV requests then? If there's no activity after, how are they being used by lenders?
It's a great question. I think they're trying to start getting a sense of where they sit in today's market and what
Mm.
they're going to do. And we've seen a lot of, all right, thank you for the information, and then
Dead quiet.
not much going on yet. They haven't figured it out yet, but
Hmm.
it's coming.
Really, you think so?
It's coming, yeah. It's coming for a certain amount of them because
Hmm.
a couple of the deals that we're underwriting, we're not even coming to, you know, 60 or 70% of the loan on the
Right.
books.
Yeah, yeah.
And that's a problem. If we were coming to 100% of the loan, they'd have
Yeah.
they'd
Now you
have,
can exactly.
yeah.
That's really interesting. Any other major impacts on multifamily in general? Like, for example, I read an article this morning. I don't know where it was. One of the real estate journals about student debt impacting and all this now coming due, uh, impacting multifamily. Are you seeing any other with the jobs reports you've talked about, kind of macro influences having an impact on demand and what you're seeing in the market?
No, I mean, more of what we're seeing in the market is a function of overbuilding or not building enough. And the rental rates, right? So in the Sun Belt and the Dallas markets and
Hmm.
um, a lot of the other Texas markets where there was an exorbitant amount of units being built. And so now they're trying to absorb them. It's definitely affecting uh, and let me back up a second. So
Hmm.
areas like, I'm in Chicago right now. You see virtually zero tower cranes building apartment buildings because they make it so difficult for the developers to develop deals,
Hmm.
um, thinking that they're protecting their constituents in the market, when in actuality, you want to have overbuilding to provide affordable, the rents drop when you overbuild, right? Because
Right.
now the developers have to compete with each other for tenants. So they
Right.
have to provide better amenities, better service at a lower cost for the tenants, which actually helps the affordability crisis in this country.
Isn't that ironic?
It's
When you
totally
think about it,
ironic.
it's ironic that actually what local governments could do instead
Yep.
of lobbing rent control, and I've got a huge thing about rent control at the moment, so I'm
Yeah.
facing it at the moment personally.
Yeah.
Instead of inflicting rent control, is actually to encourage massive development,
Yes.
right? Huge, massive development, because then what happens is all this stuff, and then prices come down, rents come down, and guess what? If you're on that side of the equation, and I've sat in these meetings at council meetings and neighborhood council meetings, they all have a beef against developers, the
Big
big,
time.
rich, powerful developers. So if you really want to have a beef, give them free runway
Yes.
to develop and build, and then watch them collapse.
Yeah.
And in the meantime, you've got all this stuff on the market that now has low rents.
100%. I mean,
The
and so
irony. Yeah.
that's the other thing is we always say today's class A is tomorrow's class C. So it's like,
Mm,
but you need to have, it's economics, right? It's
mm,
101, supply and demand. If there's a ton of supply, the demand or the value that you can charge drops. Where if you're not building units,
mm,
which we have an extreme shortage across the country, right? I think the number's been kicked around at 4.5 million units that we need to really help with the affordability crisis in this country. You allow developers to build those, the affordability crisis fixes itself practically.
mm. What about institutional activity? I was talking to Greg McKinnon at Priya, last week who was talking about institutions backing out. They're all stuck with offices they don't know what to do with.
Yeah.
I'm over exaggerating, right? Do we sell and take the loss, or do we just hang in and hope values come back? And he said basically they're frozen in a
Yes,
similar way, but for different reasons than the housing market is frozen. So
exactly.
are you seeing any impact of either way with institutional activity in
Well, I mean, it's not that's not the arena I play, is the institutional. But I mean, I watch what's going on with the
Mhm.
portfolio sales, and I mean that was a huge factor that was driving the volume in 21 and 22, where these big institutional, buys. I've seen a couple, and you've probably read about them. I mean, billion-dollar portfolio buys over the last, 12 months, both on the affordable side and the market rate side. So there is activity. It's just not to the extent that we saw, 3, 4 years ago.
And does that institutional activity, when you see more institutional activity, even though I know you're not, it's not the sandpit you play in necessarily, but you are aware of it and how it works. When you see more or less, does that have a direct impact in any way on the sub-institutional level that you do deal with in terms of pricing or
It's a great,
activity?
it's a great question. I would say not necessarily.
Hmm.
Not necessarily. I mean, unless, because when I'm thinking of when you're talking institutional class deals, typically those are going to be the highly amenitized lifestyle communities that are being purchased.
Hmm.
Which it's two totally different markets when you're talking workforce housing versus lifestyle communities and what's
Hmm.
happening there. And frankly, the workforce housing cohort has really been crushed from an uh, uh, like a rental rate standpoint. The rental rates have gone up significantly on, Class C and B assets, and they're
Hmm.
dropping on Class A.
Are they?
Yes.
That's a common pattern, isn't it?
Yes.
See more concessions on Class A.
Absolutely.
Mm.
Because those are the only things that have been developed, either at the highest
Right.
end or at the tax credit end and the lowest end.
Yeah, it's interesting because what happens with Class A is that the only way you can build is by assuming super high rents to
Yep.
justify the prices that you have to pay to compete to be able
Yep.
to build these things. And so when they come out, if you don't hit those numbers, they and then you start. It was, I remember this when I was first in real estate. I didn't know what was happening actually because it was my first rodeo. This was in the 80s. But I
Yeah.
remember driving around seeing apartment buildings suddenly with these tatty banners. They'd hang up a banner, 2 months free rent, and they
Oh
were
yeah.
always tatty. They
Yeah.
were always
Yeah. Yeah.
kind of
Yeah. They've
not
been up for a
quite.
while.
Somebody had just hung them up with a whatever paper clip or something,
Yeah.
and,
Yeah.
I wasn't really aware of. It was just it was curious to me that it was happening. I didn't know what was happening. Are you seeing a lot of that then?
We're seeing concessions and loss to lease a lot more in the financials for sure.
Hmm.
Yeah.
Loss to lease, just define that
The
concept.
loss to lease, that would just be, if the market is 2,000 and you're offering it for 1,500, your loss to lease is $500 for that unit.
Hmm. But are you seeing people actually reducing rents or giving away free rent, which is the same thing? And
On the higher
therefore,
end, it would it
in
would
their
be
pro formas, they've still
yeah,
got the rent that
yeah.
they projected.
They're signing a 14-month lease, right? Um, 2 months free kind of thing. I mean, you're seeing that in the higher end for sure.
Mm. Gosh, we've been talking for quite a while. I did have one other question, I guess, and that is capital flows. What are you aware of in terms of the availability of capital, both on the debt and the equity side for these transactions? And you say very busy as well. It's kind of curious.
Yes.
I suppose that actually is more important to me is what's going on. Like, what are you busy with all this uncertainty? Like, where's the activity? And I mean, I'm assuming that capital is flowing. Otherwise, you wouldn't be so active.
Yeah, I mean, I'm talking to more and more operators that are wringing their hands to deploy capital. They just can't find deals that are penciling for their team, and they're starting to stretch. But yes,
Ah,
the capital is there. The debt actually is becoming interesting. We just had a client was quoted 5.2% interest only for 5 years on a Fannie deal. So the debt's there, the equity is there. It's just the main thing is still trying to narrow the gap of what a seller is willing to sell it for right now with how robust the metrics are that they're experiencing on the rental side in certain areas.
hmm.
So, but look, in every single market up or down, there's always a reason for a group to sell, right? And they're only selling for two reasons. Either they have a problem or they have another opportunity that they're going to go after. That's the only reason a seller ever sells a deal. There's no other reason.
It's because they're looking for something else or they're
Yeah,
under.
they have a problem or there's an opportunity. The opportunity could be, look, we're getting, $10 million above what we paid. That's a great opportunity, right? Or the opportunity is we have we're going to grow and go into a different market. There's an opportunity, so we need to sell this. Problems are going to be, the property is, they're very management intensive in multifamily. They don't want to be doing this anymore. There's a partnership disagreement where they want to go different ways. Sometimes if it's on a private client side, there's a health issue. They don't want to run these deals anymore. Family issue. So I mean, there's always I always say there's a deal of a lifetime in every single market that you can find. It's just in these kind of markets you have to look a little harder.
Uh, Reid, thank you for joining me. Let me ask you one last question before we wrap up. So, key signals. We're in September 2025. So, what are you keeping an eye on? What are the key signals that you monitor to kind of get a sense of the pulse of the market?
Well, I'm always looking at the jobs report and I'm looking at the interest rates because we have people that are still thinking that they're going to be dipping before they sell. So they're holding off saying, you know, we'll wait till this goes down.
Mm,
But again, I think that that bonus depreciation is kind of combating that a little bit, where it's infusing a little bit of excitement into the market,
mm,
and allow it's a major incentive for groups to continue to buy moving in. But I'm looking at
mm,
how strong the jobs are because that has a direct impact on what tenants are able to pay from a rent standpoint. And that's really a key driver for multifamily moving forward.
mm.
So, hopefully it remains robust. I just don't know. I don't know how it can't. You know, we
How it can't what stay how it
yeah.
can stay robust or
Well,
I mean
there's
it's
two
definitely
different
going
trains
in
of
the
thoughts.
opposite direction, right?
Yeah, exactly. I mean, there's two trains of thought. There's one, you know, people cannot find enough qualified prospects to hire. It's like people are still not looking for jobs from the COVID downturn, right? And it's
Is
never
that what it is, or is there an immigration impact on this, or deportation? I guess is the actual
it,
word.
it might be, but I'm talking to owners that are having a hard time keeping managers, right? Where in markets where maybe a salary, I'm talking about deep secondary and tertiary markets in the Midwest, where they were once, paying 55, $60,000 to a manager and having no problem finding them.
Hmm.
They're now upping it to like 80,000 and can't find somebody for the job that's qualified that wants to do it.
Why? Why is that?
I, it's mind-boggling. I mean, I have one group, we sold them 230 units. He's like, I'm willing to pay somebody 100 grand that I was paying 50 just to manage it, just to. I was like, well, maybe I'll have my wife move down there
I
3
was
years
going
to
to
manage
say,
manage it.
sign me up.
Yeah. So
I've got an 18-year-old who's looking for a
right,
job.
right. So. That's continuing to be an issue
God,
is
that's
on the payroll
incredible.
side, which is just
Really?
incredible.
And
Yeah.
that's a consistent problem, is it, that you're
Yeah.
seeing?
Yeah.
Wow, that's really interesting.
Yeah.
All right, Reid Bennett. Focus. I'm reading what you've got on the screen here. Reid Bennett, CCIM, multifamily specialist. As always, an enormous pleasure to see you. Thanks for joining me today.
Hey, thanks for having me on, Adam.
All right, that was Reid Bennett, National Council Chair, Multifamily Properties. Thank you, Reid. It's always good to see you. Those are very interesting insights that you shared. As I mentioned during the podcast, I did find the insight into the fundamental difference between the economy during the global financial crisis and now, particularly as it relates to home ownership. I hadn't actually thought of it quite in that lens, but you super simplified it. And for somebody like me, that's a really good thing. So thank you for sharing that insight and for everything else and for your time today. It was really good to see you. And thank you to dear viewers and dear listeners. Glad you were able to make it today. Please go ahead and subscribe to my newsletter at gowercrowd.com. Actually, when you click on the subscribe button, I do share the companies or some of the companies that other subscribers work for. So you'll see when you go there that you will be in very good company. Okay, that's it for this episode. And until next time, this is Adam Gower signing off.